Good morning. I am Elena McCargo from the Urban Institute's Housing Finance Policy Center. I am excited about this panel. I've been very excited about all the conversation we heard this morning, and then the discussion that we're going to have, which is going to shift gears a little bit and take us back a little bit. So I am thrilled to kick off this morning panel with this phenomenal group of colleagues who represent very deep expertise and diversity of experience around every conceivable barrier to consumers and the credit cycle that you could think of. And so we're going to keep introductions brief. You can see speakers' names and faces on the screen, and their impressive bios are in your conference packets and available online for those of you that are streaming live with us. So I'd like to welcome you, each of you, and thank you for being part of this very important conversation. Our panel is going to focus or spend this hour talking about the new dynamics and demographics of consumer credit and the many obstacles that consumers are still facing in entering the credit spectrum, even at the most basic levels. And we're going to discuss how their organizations have shifted approaches to meet these needs, what's working, what's not working, who's advantaged by it, who is not. We're going to talk a lot about many of those issues that are still ahead of us. Obviously, the context or backdrop of everything we're talking about does have a little bit of a, how does the technological evolution play a role in what's happening on the credit spectrum as well as in the housing finance system? And so we're going to be talking about emerging technologies as well, and how data and some of the things that are happening in the technological space are helping in this space and helping consumers long term. While this is a housing finance symposium, we did decide to start this panel in the very beginning with sort of consumer finance and barriers to credit, because we know that we know a few key facts that are really shaping and creating incredible issues and constraints for the housing markets. And so if you can't even get into the credit spectrum, your ability to buy a house is very hindered. So we're going to talk a little bit about that. So I'd like to just start by asking each of the panelists, just tell us a little bit about you, your organization, what your organization is tackling as it relates to barriers, obstacles, and opportunities around the issues of consumer access. Please do so in 2 minutes or less. And then we're going to get into the meat of our conversation. Thank you and welcome, Todd.
Okay, I'm Todd Baker, Senior Fellow at the Harvard Kennedy School, and my work is focused on fintech startups and their potential for improving financial health for low-income working Americans. My most recent work is focused on fintech alternatives to payday, auto title, bank overdraft, and short-term small dollar finance for low-income working people. And I reached some fairly positive conclusions about the potential, particularly of the employer channel, to helping distribute and make available better, cheaper or alternatives that would help people avoid the need to borrow in the first place.
Great. Teacher?
Thank you. I am Nikitra Bailey, an Executive Vice President with the Center for Responsible Lending. CRO is a nonprofit, nonpartisan research and policy advocacy organization dedicated to protecting homeownership and the family wealth that it creates. We are an affiliate of Self-Help Credit Union, which is a national credit union that has made over $7 billion in financing to borrowers who are historically underserved by the traditional banking system. We also have a credit union network at Self-Help. We are serving over 130,000 consumers in North Carolina, California, Illinois, Florida, and Wisconsin. And our goal is to really provide credit in communities that are undersourced. CRO's work really focuses on abusive lending practices and the costs that they do bring to American consumers. Those costs really harm our national economy, and they make basic financial services really expensive for people when they should not be. So our advocacy seeks to really bring fairness in the financial services sector so that all people have an ability to thrive.
Thanks, Nikitra. Erin?
Hi, I'm Erin Courier. I direct the Financial Security and Mobility Project at the Pew Charitable Trusts. Pew is an organization that has a wide-ranging set of projects ongoing related to research and advocacy. But one of the things that we've been focused on for about a decade now is the health and status of the American dream. Really thinking about the ways in which people experience economic opportunity, the things that enhance or hinder that opportunity over the long haul, And one of the things that we have really narrowed in on is that if you care about opportunity across generations, then you really need to get down to the kitchen table issue of family financial security. So our work is focused on really understanding family balance sheets, thinking about them holistically, income, expenses, savings, debt, and trying to understand the ways in which all of these balance sheet elements combine to create financially secure or financially vulnerable families. And our work is really trying to get at where there are opportunities for policy to move the needle to create better financial resiliency and also in the long term, increase economic mobility.
Thanks, Erin. Rob?
Thanks, Elena. Good morning, everybody. I'm Rob Crane, CEO of Down Payment Resource. And my background is real estate and mortgage banking for about, well, I'll just say 30-something years. And one thing that always kind of troubled me during that time was the amount of financial resources available to home buyers, especially low to moderate income home buyers, first-time home buyers, that was available but underutilized. So I thought somebody needed to fix that. Be careful what you wish for, because it wasn't my intention to do that. But anyway, I went through a long explanation sometime when somebody asked what we did, and they said, "Oh, you're like Match.com for down payments." So I guess that's all I need to say, really. But we connect people with hard-to-find financial resources. But I think the heart of it, the key of it, is well, why is this needed? What's so hard about giving away money? I mean, billions and billions of dollars out there to help people. And well, there's two things. One is most people, the people that it's intended to help, don't know about it. Today, they still don't know about it. A lot of people are using the programs, but a lot more people don't know about it. Number two, it's hard to find, and the rules for accessing this are complicated, confusing, it's very fragmented. So our approach was simple. We built a database of all the programs across the country, local, state, national programs, home ownership programs, primarily down payment assistance, but there are a host of other affordable lending programs that can help with affordability. So it's about 2,500 programs, give or take. We work with about 1,300 different HFAs, state and local housing finance agencies, federal agencies, to keep this information up to date. And then we built a search engine to automate the process of matching home buyers, the properties they want to buy, with these programs. And then we make this information available, the information and the tools available to consumers, either by licensing it, they get it through their lenders or realtors, because we license it to lenders and multiple listing services, or they come to our website. So all this activity has generated some unique and actionable data that I look forward to sharing.
Great, thank you, Rob. Marla?
Good morning. I'm Marla Blow. I'm the CEO and founder of FS Card. And at FS Card, what we do is offer a traditional mainstream credit product in the form of a credit card, unsecured, to deep subprime consumers who are otherwise using payday loans, other kinds of alternative products to meet their borrowing needs. And part of the idea behind starting the company was really to focus in on the consumers who are using these alternative products in a universe where new rules are likely to show up and have now been released on changing the payday landscape, making even that instrument either very difficult or much less available. And so what we wanted is to put those consumers in a position to be able to access liquidity at a price point that makes sense and is consistent with how they consume it, in a way that we all take for granted every day, by having access to a revolving line of credit on demand when we want it and need it, and put them in a position that when the tide recedes on these alternative products that are also very difficult and often can be problematic, that there is something else available, that we create some much needed supply to replace that as it starts to ultimately react to the new rules as they come in. Thank you.
Thank you, Marla. Thank you all for those great introductions to help us get to know this panel. And let's jump in. At the Urban Institute, one of the things we like to do is talk about facts and data, and many of you know that. And I thought I would just start and then jump into a question that really helps to set the foundation of the consumer demographics and some of the issues on the consumer finance side that we're dealing with. We know from some great work that was done by the Consumer Financial Protection Bureau that 26 million adults lack a credit history with the National Credit Bureau. Another 19 million are completely unscored, meaning that their credit records are thin or non-existent and they cannot produce traditional scores. That 45 million consumers that are invisible from accessing, are completely invisible from accessing credit through traditional mechanisms. So that's 45 million people who are just not even on the spectrum and certainly not on a path to homeownership because of that. One other point I wanted to make was more than, and this goes to the savings point, more than 50% of renters in this country today are cost burdened, meaning they're paying 35% or more, 30% or more of their monthly income in rental payments. So how are they going to save up for a down payment when 30 or 50% of their income is being absorbed in their rent? And I'll add, incomes are flat. We're seeing very little income growth. We're seeing much more variable types of income, and Frank and others this morning talked a little bit about that, the gig economy and some of the things that are happening where folks are working more part-time. So we've got some things to consider there that are, again, I put this in the category of a barrier. The last thing I'll mention is with all of that and sort of the inability to get up the upward mobility into potentially home ownership, net worth in this country is sitting in home equity for most Americans. That is especially true for Blacks and Hispanics. And when the majority of your wealth is in your home and you have no way to get into that mechanism of building wealth, therein lies a problem that is continuing to perpetuate the gap. So with that, I'm going to, as a backdrop, I want to start. There have been a few reports that have been released recently. One being the Federal Reserve's Survey of Consumer Finances. The Census released their annual income and poverty report. These reports, interestingly enough, in 2016 show that there's been some gains or some positive signs overall for consumers in the consumer finance space. But we continue to see slow to no growth for consumers at the bottom of the income and wealth distribution. So we're seeing growing credit card and student loan debt. We're continuing to see a widening of the racial wealth gap. So while there has been some signs of hope, there's still a lot of things that need to be addressed. So I'd like to just know how do you explain this? And Erin, maybe you can start with.
Sure. Yeah, I think you're absolutely right that when you take a broad look at the macro level indicators that we use to assess the health of the economy, things like the unemployment rate or the stock market or even median income, those sort of mask a lot of insecurity that's happening below the surface. And to really understand what's happening with American families, you need to go below those national level data points to get to what's happening within the households, at a household level, at the kitchen table. Some analysis that we have done, particularly as it relates to expenses after, and in the last few years and leading up to and after the Great Recession, shows that expenses during and immediately after the recession declined and then rebounded. But then if you look at income, it didn't follow the same path. Income did not rebound in the way that expenses did. And what that means is that it creates a lack of slack, right? Families, especially at the middle and the bottom, have less cushion between their income and expenses than they used to have. That plays out as well when we think about family financial security. In a nationally representative survey that we did of households all across the country, we can see evidence of this insecurity. 1 in 3 families say that they do not have any money set aside that they consider savings. 50% of families say that they're spending exactly what they bring in or even more each month. Half are saying that they are experiencing income volatility. 60% experienced a financial shock in the last year. Families have very little savings and very little wealth. And so when you put all of that together, what it begins to show is families walking a kind of financial tightrope, right? Their income and expenses are volatile. They're subject to financial shocks. They don't have any savings to sort of support them when they hit that financial shock. And then that leads to material hardship. It doesn't take a whole lot of a stiff breeze to really throw families off track. And what's worth noting is that this is not a phenomenon or a fragility that's limited to families at the bottom. higher up the income distribution than you might expect, we're seeing this mismatch between income and expenses, a lack of savings, a lack of wealth. And it really sort of underscores that a lot of families are living close to the edge, that they are experiencing fragility. Only 45% of Americans say that they feel financially secure. That is a really big percentage.
Did anyone else want to jump in on what's happening here?
I think that bears out, the Commerce Report just announced that the personal savings rate is at a 10-year low, I guess last month, almost a little less than half of what it was even 2 years ago. And that's 3.1%, and that's probably skewed upward because it's a broader segment of the population, not just low income. So that tells you how low savings are. The National Association of Realtors recently released its 2017 profile of home buyers and home sellers, and first-time home buyers, 84% of first-time home buyers took at least 2 years or more to save their down payment. 40% took 5 years or more to save their down payment. So
That's incredible. Well, I'm glad we're going down the savings thread. So saving is hard to do, and if you've been anyone that's had a savings account in this very low interest rate environment that we've had for a very long time now, you know that savings account has not grown because interest rates have been so low, and probably 0.1 or something on your bank statement. So it's a difficult time to save in the traditional ways that we've talked about. So where are you seeing advances, or should we be thinking about saving differently in the future? And how do cash-strapped renters, for example, even think about buying a home in the future when down payment is and saving for that down payment is such a huge barrier? Rob, I'll let you continue down that thread on the savings.
Yeah, again, as I was saying at the beginning, so many people don't know about it. So the first thing we need to do is double down on educating potential home buyers of their full range of options, because they don't know their whole full range of options there. And if you think about it, I think another thing we need to look at differently, at least in some areas, is low down payments. Some they've been made out to be, at least in some areas, evil or bad for you. First of all, one size doesn't fit all. Second of all, would you be better served being able to get into a home sooner, not rating your 401k or IRA account for a down payment for a home, having the savings, having some savings, having more of a cushion when you walk away from the closing table. I mean, in my career, I can't tell you the number of times I was at the closing table with clients, and they were excited and elated about buying a home, but they also were always making some comment about, I guess we'll be eating tuna fish out of a can for the next 6 months. That's really common, and it's sad that it has to be there. So it has to be that way. So if they need to understand what their options are, understand how to look at it, and think about maybe yes, we need to save and everything we can for our home or for a down payment on our home, but let's not necessarily leave the closing table with 1 or 2 months reserves. So Down Payment Resource and Freddie Mac commissioned a study with the Urban Institute on affordability and credit access. That's going to be released later this month. But one of the things the report shows is how down payment assistance programs could provide much needed help. And I've been accused sometimes about overstating or overhyping the opportunity out there for people who don't know about these programs, who could become set up better to succeed as homeowners. So one of the things we did, I'm proud of myself, I only brought one slide. I'm used to using a lot of slides.
It has a lot of numbers, though.
But lots of numbers, yeah.
And I apologize. Don't get. It'll be in the report, I think, right?
Yes, absolutely.
So it'll be in the report when it comes out. The point that this makes is that we took 2016 HMDA data, which was just recently released, and we took about 20 large metropolitan areas, primarily large metropolitan areas, and we process millions of loan files through Down Payment Resource to say, of these borrowers, how many could have potentially taken advantage of one of these programs? How many would have been eligible based on household income limits, based on sales price of the home they're buying and where they're buying and all that? So again, I've been accused of overstating it. I'm excited that we finally have some hard data, and to me it was eye-popping, the numbers. I was surprised. So so the column, the total applications by marketplace, the percentage that are, what does that say, percentage assistance?
Eligible.
Eligible, yeah. So you can see across those markets, this is not a niche. This is an important market segment. The number of people, so, again, people want to say, well, how big is this market? How big is this opportunity? Well, if you look in the rearview mirror for last year, that's a lot of people. How many millions of people are sitting on the sidelines today, not even looking? Somebody said the problem with millennials is not that they don't qualify, or they don't have enough savings, or they don't have good enough credit scores. Their problem is that they don't think they qualify. So a lot more could be done to reach people, let them know about their options, and let them figure out for their personal household what makes sense. But the other thing you can see, and I would ignore the average loan amount and average income, because that's for all of the HMDA data, all the HMDA applications. That wasn't just for people who were eligible for programs. But one of the other columns, the average number of programs that they're eligible for. If you're eligible for one, you're probably eligible for more than one. And again, going through the markets, 7.9, 8.1, 12.6. I think the low is 3.2 in Phoenix. So there's not just help, there's a lot of help, and there are different kinds of programs. The amounts, the minimum amounts could be, a low of, I think, $1,500, $1,600 to a high of tens of thousands of dollars, $30,000, $60,000. We found in some research we did with Realty Track a couple of years ago that the mode, in other words, the most commonly found assistance amount across the country through our database was about $10,000. So whatever's out there, and some of them can be layered and things like that.
Interesting. So it sounds like money is being left on the table, essentially, and that we need to get information out and more transparency out about the different programs that are available. How do people access them? There's a lot of people in this room that work with consumers that could be could benefit from understanding this type of information. And what you guys are doing is trying to make that as transparent as possible through technology and through your platform with lenders and realtors and others, which I think is great, because it really does sound like just a knowledge and awareness issue, and we know what a big challenge saving is, and this is and down payment is, and this is a really important thing to note.
Alana, could
yes,
I add something? So the other thing that I think we should be aware of is that there is one of the areas in which financial technology is really making strides through the use of behavioral psychology is in setting up new structures for encouraging savings. And the critical thing to distinguish is between savings that's used to deal with day-to-day volatility and savings that's used for a purpose like a down payment. But there's a number of very interesting companies that have created primarily mobile structures that are working in increasing people's ability to automate or gamify their savings in ways that I think are going to have an impact, especially as rates rise, because we have an entire generation here that does not consider savings to be an earning asset. Right now already savings rates, you can get 1.3% already from significant providers, and as the Fed stimulus goes away and rates rise, there's going to be increasing competition among providers, banks essentially, which is going to raise the rate on savings. So I think we should look at savings as an opportunity for starting the wealth creation ladder, and by using both the traditional methods of going for the highest rate, but also behavioral software solutions that anybody can access, which help you just make that decision automatically, and the early results are quite good in terms of what can be achieved.
That's great. Thanks for sharing that. So we've just to continue along, and we talked a little bit about some of the basically the economic wealth gap and a little bit about the racial wealth gap. I wanted to sort of shift a little bit and just talk about this with changing demographics. You mentioned millennials, Rob, in your comments, and sort of where people's psychology is when they're thinking about their financial picture. These issues span race, incomes, age. I mean, we need to think about all of those dynamics. Where should lenders and policymakers be focusing their attention to make more inroads in closing the gap?
I think we've got to deal with the elephant in the room this morning. We've never dealt with the intentional discrimination that our housing system has instituted, particularly the federal government's role in perpetuating that discrimination. So when we have this discussion about savings and ability for long-term asset development, homeownership is the way that white Americans have been able to do it. The federal government made an intentional decision to create policies following the Great Depression that favored whites. And it gave them a leg up, and it gave them a level of economic stability that people of color never had. And quite frankly, we've never experienced a financial services sector that's been fair. We've never had basic financial services in a way that have empowered us to create those types of assets over the distance. So I think we've got to be really intentional about addressing that. We've yet to do it, and we've now are in a position where we have an opportunity. We are having this big discussion about housing finance reform. So here's our chance. We're writing these wonderful proposals, and there seems to be this great consensus that has emerged, but yet are any of these proposals talking about how we get at this discrimination and how we bring families who have been stymied by the millstone of racism whole, how we put them in a position where they can get on equal footing and achieve economic parity. So I'd say we should start there. And then I think we've got to think about what are some key things in the current system that would actually allow more borrowers to enter, right? Urban's research says that there have been 5.2 million loans that the market hasn't made. That's hampering economic progress. If I am a person who wants to sell my home, those are people who cannot purchase my home. So we did this with the last go round leading up to the housing crisis, right? We thought these were problems and these were issues that only impacted people of color, and we didn't come together to provide a national solution until it became so systemic that each of us, how many of us are homeowners in this room? Each of us felt some pain because foreclosures impacted us, because even if you didn't receive a foreclosure, you felt spillover costs if you lived in proximity to foreclosure. So each of us in some way ended up paying for this lack of attention and detail because we thought it was happening in communities that didn't necessarily look like the majority. 7 out of 10 future home buyers are going to be people of color. That's just the market. We've achieved the level of homeownership for whites that's about 70%. It's been there for a really long time. It's not there for borrowers of color. It's under 50%. And in fact, for African Americans, we're right back where we were in 1968 when Congress passed the Fair Housing Act. So all of the progress that we had hoped that we made has just been wiped away. But we keep focusing on systems without talking about race. And we are just at a point where that's not going to work for us. We won't have a healthy economy if we don't get at the structural inequities that are perpetuated by race and create systems that are more equitable as we go forward. And I don't know how else at this point to talk about these issues, because I think we've done all of the other things. Like, we've looked at all of the research and we've come up with all of these fancy things, but we never want to roll up our sleeves and talk about race. And I am just at a place where it's just been proven that if we don't address the fact that we said to African Americans, Latinos, Asian American, Pacific Islanders, we're going to sit you over here and we're not going to allow you to fully participate in the system. And then we all end up paying for that. So now we need to come together and put our brilliance around creating some solutions that address that, so that as we go forward, we're not continuing to repeat the mistakes of the past, but we're building a solid middle class that will be stable.
I almost want a round of applause. Thank you. That was very, very good. Very well said, Nikitra. Did anyone? I mean, you hit on. I mean, you just hit on a lot of the issues, and the focus that we kicked off with around the racial wealth gap, in particular. I don't know if you wanted to, if anyone else wanted to comment on that point. I think you addressed that incredibly, and I.
Yeah. So the only thing I would say is that the challenge is there's this huge denial in the system about what occurred in the 40s and 50s. And if you asked, there's virtually nobody will, how many people do you think know that story? Almost none. And so it is, it gets viewed through our political lens now and becomes very difficult to deal with. That doesn't mean we don't have to address it straight up, because you look at the racial wealth gap and it's increasing. It's and the subprime experience actually destroyed massive amounts of African American wealth. And there's something about this that is not going to be resolved. Financial services can't resolve it, right? Which is, I think, it's the Band-Aid on a gaping wound. But if we don't address it straightforwardly, we will never make change, because this kind of incrementalism that we all represent doesn't really get to it.
And even before we got to subprime, right, we've got to talk about the fact that there was unjust redlining. So our experience in the financial services sector has always been plagued by some level of unfair treatment. And I think it's important that when we talk about taxpayers, we often ignore that we are the taxpayers too, right? Like, we help support all of the depository institutions, right? Like, our taxes ensure that those deposits are safe, but we keep saying that our communities don't have skin in the game. But in fact, we do. Our skin in the game is just being used to help people in better financial situations than us.
Yeah, one of the points you made, and we'll put a fine point on that, is the opportunity as we look at reforms comprehensively up and down the scale to think about and kind of think about this through a lens that thinks about what happened, where we've been, where the problems were, and really works towards solutions that help to address that. So that's a
and to get at like the incentives, right, and get at the structure, so that things like loan level price adjustments that we see today, that we know are just excessive risk-based pricing, get at the things that are actually contributing to the fact that 5.2 million loans haven't been made. Right. And just like, let's just stop it.
Right.
Yep.
Yes, please.
I could not possibly agree more, so thank you for saying it. And I'd add another view on this and just look at some of the ways that the headlines obscure some of the points that Nikitra and others are making. And this is one of the big ones, is just looking at the data coming out from the New York Federal Reserve, which shows a total consumer debt at a headline level, looking at nominal numbers, is back to and surpassed kind of the peak prior to the last recession. So if you look at 2008 to 2017, where you can see this sort of 1% headline increase on where we are. But if you unpack that a little bit and look at what's going on, and we really only scratch the surface on looking at this. If you look at what has happened from an inflation perspective and you adjust for personal consumption expenditures, inflation adjusted, which is what we used, there's roughly a 13% increase in inflation from 2008 to 2017. And I'm speaking to people from the Urban Institute and other places, so there are lots of people who've looked at data like this and probably have other views, but there's a number of ways that support this. But it shows that on an inflation adjusted level, we are actually not at an all-time high, right? And that story that sells newspapers, and that is an interesting headline for people to look at and think through, obscures the fact that this is not nominal. This is not a nominal world, right? And thinking about how we act within that world is pretty important. Beyond that, there's also been population growth, right? And the population has expanded about 7% from 2008 to 2017. And so on an adjusted basis, the number of people with access is worth kind of looking at. If we went a layer deeper, which we did not do, But if we added the demographics that Nikitra's talked about, and I think, Elena, some of what you were referencing as well, where that population, where that access now resides, you would see meaningful concentration, right, in certain parts of the population and increasing scarcity in other places. We didn't go to that level of detail here. But what we did look at is what are the obligations that consumers face and how does that tie in with their income? Income, as we know, is obviously not evenly distributed, so if you looked at the distribution of income, you could get an even finer lens on this. But again, we are essentially back to where we were from a per percentage of income allocated to debt obligations versus where we were prior to kind of the recession. So looking at and unpacking this a little bit is critical, and this is the one that I really want to leave folks with, right? If you adjust for the items that we just talked about, taking the categories of debt here, there's one item that stands out, right, pretty clearly and pretty dramatically. And so this started with a conversation about what would we leave the policymakers with and what would we advocate for. There's a thing that needs to be addressed, right? And we're working on making access available to people for credit cards, which I talked about a little bit. We've got people working on mortgages and down payments and what Rob talked about. The student loan situation is moving into uncharted territory for us, right? We've just not seen this level of student loan debt, the distribution of student loan debt concentrated obviously in the millennial population and younger people who are just starting in their lives. As we look at this from a credit perspective and thinking about giving out credit, we are focused on a population that traditionally actually has not had student loan debt because oftentimes student loan debt has been associated with higher levels of education, which correlates with income, and we are for the first time starting to see meaningful amounts of student loan debt in deep subprime populations. And it's new, and it is associated with, I'm now speculating, right, it's associated with for-profit education, vocational technical education, other kinds of education that does not necessarily tie as directly to upside on income. And what does that then mean for the growth, for the development, for the ability to ever access home ownership, et cetera, right? So going one level below what's at the headline and what might seem like, oh, access to debt is okay, we are indebted as a society and we are back to levels we were prior to the recession, obscures a lot of those challenges, and I think it's really important to look at and keep that in mind.
Could I just jump in there too? I think that completely agree with all of the points that have been made, and one of the things that we have looked at in our research on debt is that if you look at the people who have the most debt, they also tend to have the most wealth. Exactly. Because that signals an access to credit, right?
Exactly.
So if you have debt for home ownership and debt for education for the most part, right, you're looking at a tier of people who are leveraging debt for wealth building. They are able to access debt in ways that boost their income and wealth mobility over time. And so it's not good or effective to just look at an overarching amount of debt across the population and make some assumption about whether that's good or bad. You really do need to get below the surface. And to your very good point about student loan debt, one of the things that we've been looking at a lot as it relates to student loans is who's actually struggling with that debt. Who are the people that are in default or in delinquency on that debt? And it's not the people who you might expect who have $100,000 in loans and are working at Starbucks. It's actually the people who have $5,000 of debt, right, who potentially attended a for-profit university or otherwise started a degree and weren't able to finish it, or finished a degree but it didn't actually have any payout for them in terms of their labor market earnings. And so that is not a terribly attention-grabbing headline, that it's the people with the least debt that are the most likely to be in delinquency and default, but they are the ones that deserve the attention, that need a microscope placed on them in terms of understanding where policy has failed them and where there could be better supports put in place so that people have access to debt that actually moves the needle on their economic mobility.
Great. So as we talk about where kind of the state of things, and this was very illuminating, and I appreciate you, particularly this slide, sharing the debt side of the story. I talked a little bit about credit and the credit invisible population, and we have seen, and there's some innovation and technology and data that are coming along that are really helping to get people out of this invisible status onto the grid, and then hopefully into a situation where they're visible and able to participate in a meaningful way. Within all the technology that's there, and we talked about a lot of interesting things that just remind me that, when we're dealing with a lot of data, there's all these algorithms, there is embedded bias in that. Who has that debt that you were just talking about? Who's had that opportunity to build that over many, many years, and who has not? We have to think about, there's some things in all this automation that really still do contain some bias. But I do want to ask Marla, can you just talk a little bit about what is going on that is helping, what are things that you're doing that are working towards reaching more consumers, getting them out of the invisible space and sort of on the grid, and kind of where do you see that going?
Yeah, no, that well stated question, and certainly we are aware that algorithms that use data that we have built up over long periods of time take into account and are built on the exact bias that Nikitra was referring to earlier. So it starts with the premise of what is predictive in this country, and algorithms are not burdened by sensitivity to demographics or understanding the story of history or the various stories of history in this country, and can, on a very flat basis, take that information and make decisions that perpetuate the exact problems that we talked about earlier. So one of the things that we invest heavily in is making sure we are looking for not just a history, but a change in the trajectory today, right? So what we're looking for is what suggests some signal that is different about this consumer? What suggests a change in trend? What suggests a new access to liquidity here? What suggests a new sort of bias in their own behavior? And there are trended pieces of information, natural language processing. There's lots of novel ways to be able to use all the data that we create about ourselves. So everything we do, every time we pick up our phone, everything we click on, we're sending signals. And those signals are useful on being able to make a decision on the margin that is not just informed by the legacy of this country, which is a very difficult legacy to unpack, right? And Nikitra, I think, said very well, we struggle as a nation to have language about how to engage on that and how to feel comfortable talking about it. Now, knowing that, how do we bring ourselves to a place where we can start doing something different from this point going forward? And I think data and the possibilities of data and the possibilities of new algorithms make it plausible for us to do something different going forward, but it requires some incremental input, right? In our case, that input comes from the human side, the people that work inside of our organization, and I'd like to think in other sorts of fintech companies that can look for information beyond what the history might suggest and look at what else is there that sets a prediction about where that customer might be headed, not just where they've been. And but that is the challenge, and that's the important thing is to train. Algorithms have to be trained, AI has to be trained. If you train it on that bias, it will perpetuate the bias and incorporate the bias.
Very
so important for us to do something different than that.
Yes.
And if I could add, I think innovation is awesome, and it has an opportunity to really be groundbreaking, right? And we have other tools that we're not using. We have fair lending laws that we're just not enforcing. We have CRA. Why aren't we enforcing CRA? Banks have an obligation to serve the credit needs of the communities in which they operate, and they're not. And there's no real enforcement or any teeth in CRA that causes a difference of behavior. So what we end up with are these separate systems where we have this dual financial services market for different segments of borrowers. So we've got to get right at that and really strengthen our enforcement efforts with our fair lending laws.
Yeah. So I want to ask one last question, then I'm going to open it up to the audience. So we've talked a little bit about, you talked about technology and innovation. I want to ask the question is, do we think technology and innovation or financial technology, fintech, is expanding access to credit for underserved communities? Do we think that credit will be more expensive as a result of that? Do we think that that when it comes to regulating financial technology, that we've got the right things in place to ensure that fair lending is built in, or that the algorithms and the AI robots know all these things to think about? Monitoring for abuse. How do we protect privacy? How do we ensure fair pricing and underwriting. I mean, there's a lot to unpack in that. You don't have to answer all of those, but these are things to be thinking about.
Sure.
But I just wanted to ask that question, and Todd, get your perspectives on it.
So I think about it on a number of different levels. Sort of on the macro level, the fintech lenders did fill a gap in the immediate post-crisis period because they were starting up without legacy issues, and they did provide, particularly in the area of lower income, lower credit score folks, levels of liquidity that the banking industry wasn't going to. Now, in the period since then, really, or if we look back further and say prior, if we look to the year 2000, they're really not incrementally adding, they're essentially replacing what was provided by the traditional HFC, beneficial finance, Sears credit, the traditional finance company business, because most fintech lenders, are a superior method of delivering a finance company experience. So I would say those things, but I think we have to look a little more deeply, and I think Marla hit the first really significant thing that fintech can do, which is broadening the base of borrowers through additional sources of information and looking at information in a different way, which is what they're really trying to do at FS Card. The challenge with that is we won't know whether that really works as an economic matter for a lender until we have a recession and interest rates rise. I'm very hopeful that the power of this data, and particularly as we get safer and better ways of accessing bank data for use here, will provide a significant deepening of the kind of person to who you can give a fair price loan, as opposed to lumping them in with everybody else who gets the worst loan. The second area, and I think this is to me the most important really, is we can use fintech to change behavior, change people's financial behavior in ways which will both improve their financial health generally, but more particularly make them better candidates for credit. Because financial technology has the ability through, we all make terrible financial decisions, that's just a given, despite what economists might think. Financial technology can help us make fewer of those bad decisions and more good decisions. And so I think one of the guy from Freddie Mac mentioned EarnUp, a good example of trying to get people's financial lives rationalized in a way and give them nudges and hints and other things which push them towards good decisions. That eventually leads them to the place where they can qualify for more traditionally priced credit. The third thing I'd say about fintech in terms of its potential here is I really want to emphasize that there's 50 million people who work for companies that have more than 1,000 employees. There's 65 million people working between 15,000 and 50,000 folks. Those folks overlap a good deal. The employer channel is a great way to try to improve financial health in ways that can help people and gain access to lower cost financial services. And I'm really hoping that this trend, which is beginning, gains some speed in the next year or two, because I think it's probably the best way for the largest group of people to gain superior access to lower priced financial services.
And I would add, it's important that they're regulated and that they don't evade state consumer protection laws, because we know that some of the companies have already had enforcement action taken against them because they haven't delivered the actual benefits that they offered. So we want to make sure that this isn't a way for lenders to start skirting consumer protection.
Goes without saying, yeah.
Absolutely. Rob?
Yeah, I think that blinding flash the obvious, but I think the important point that's being made here is what technology and fintech can't do, at least not yet. And so I'm as excited as anybody about what it's doing and what it promises to do, but as these algorithms are tweaked and perfected, and as more data is gathered to do so, and policy that might be driving what those tweaks are, there are a lot of borrowers that need to be manually underwritten, and today technology can't do that. So the other thing is that in terms of educating consumers, about their options and helping them make better financial decisions. That's another area where technology can help in terms of, digital media and reaching people that way. But again, there's a point at which you can educate people, you can make them aware of things, you can give them a call to action, but there's a point at which they need to be handed off to a human being who's trained, who has the skills and the motivation to take their hands and walk them through it. I mean, even I heard somebody talk about millennials at another conference recently, and they said, oh yeah, everybody knows millennials love technology and they want to do things their own way and have choices and all that kind of stuff. But even millennials still want to be, when they're ready to do something, they want help. And the point that they were making was, well, so many of them grew up with helicopter parents that they're used to getting help at some point. So anyway, I have all the hope in the world for technology, but it's not going to. There's still that human element that whether it's underwriting or counseling or whatever, that is going to continue to play a really important role.
Yeah, that's well said. And the thing I'd add is a lot of the focus in the fintech space and in the innovation space has been on making things more convenient, right? Making things quicker. You see the advertisements for you can get a mortgage while you're at a football game on your phone or something like that. And that is I guess useful maybe on the margin. But that's going to serve a well-served population, right? That is people who already have access, and if they're trying to get you to choose Quicken versus Bank of America, right, or something like that. And when I go out and talk about this, I encourage people in fintech, my peers, my other investors in this space, to look at the populations that are not just looking for convenience, that it's not okay to just decide, well, everybody that has an iPhone can solve this problem this way, because the number of people that have iPhones is a very specific group. And understand that population is attractive, right? Is relatively affluent, has a lot of financial needs, but serving the needs of the groups that's excluded and finding ways to perpetuate inclusion and communicate with people some of those tips, and I think some of the things that Rob's alluding to, is an opportunity that is also incredibly lucrative and can be one that with effort can be made to work. And it's that willingness to apply that incremental effort is where we really try to differentiate ourselves. And that's what I hope we'll see more of in this space.
And I think, Marley, you're absolutely right. One of the oddities of fintech immediacy is pushing people to make financial decisions
quickly,
immediately. So a good example is the rise recently of point of sale financing, the revival of point of sale financing, but through a digital internet thing. So where you're trying to buy something and you're offered financing at that moment, you can say yes. You're signing on to a 2-year installment loan, right? Is that really a decision that you want to make instantaneously? I don't think so.
And I think we just got to be careful, because I think we haven't provided the basic level of services yet.
Right.
And I think every time we talk about new communities and emerging communities, we feel like we have to do something special and something unique. Well, abusive subprime lending was special and unique, right? And look what that got us. So I think we've got to just try to get back to some basic vanilla type of practices in communities.
Great point. I want to give the audience a chance to jump in here. So if you'd like to just raise your hand if you want to make a comment or ask a quick question of the panel. I know we've covered a lot of ground, but definitely want to take questions if you guys have any. And they'll come around with a mic. Anyone? Don't be shy.
Obviously, we were pretty boring.
All right. Well, we have one in the back, Ed. Question was, how do we get the technology into government programs? It's a great question. Anyone want to take it?
So I'll jump in on that one. And so as I jump in, I should say I am a former CFPB team member. I do not speak for the CFPB. And I did not then speak for the CFPB, so that's, just make add that as well. But I do think one of the challenges that the government faces is being on the bleeding edge actually doesn't work particularly well for the government. It is likely that what the government ends up leading will be the thing that other people circumvent, right? So figuring out how the government can be a fast follower, I think, is probably the best aspiration that one could hope for. That said, I don't think fast follower is the way we would describe kind of what's going on today. But I do see some encouraging signs. I do see use of latest sort of later stage kinds of storage and cloud-based services, being able to access where we can accomplish a fair amount nowadays with our government through GUIs, through online interfaces, through digital interaction methods. But I do think it is important for the government to continue to make advances and try to keep up where possible with some of the developments that are out there, because it can get away from us before there's even time to react or intervene. And that's only accelerating with where we are right now. So I share that same sentiment, but recognize the limitations on, the government's not going to be out front.
Do you want to take a stab at that one?
Well, I will put a plug in for the Kennedy School, which is focusing on building technology thinking into the training of a future generation of government leaders. So when I'm dead, maybe it will happen.
But we joke. I think it's important, and I think Ed, it's wonderful that you asked this question, because HUD desperately needs its technology updated. It's really hampering the financial services sector and the ability for mortgage credit. So I think it's excellent that you raised that question.
Great. Anyone else have questions in the room? Yes, Jean?
Thank you. Oh, is that on? Yeah, sounds good. Todd, just follow up on your comment related to point of sale financing. I experienced a presentation by one of the leading marketplace lenders, and they're describing their underwriting engine, the algorithms involved in making credit decisions for people, at that point of sale. And it was really incredibly fascinating. Back in the day, I had some experience working on the development of fan base.
Right.
And so, they sort of taking credit analysis to way beyond anything I considered. But there was a heavy emphasis on the character of the person. So mining big data to understand, okay, who is this person? And so, it's fascinating, an advancement to some extent, but also it brings into, a lot of concerns about that, because there's some of the dimensions that they were taking into consideration. Not all people would look that good. So the issue was, while encouraging innovation is important. So, but what do you think about the potential downsides of that, and how does the system sort of regulate that process to make sure that
that's one of the questions we didn't get to, which probably deserves its own seminar. Right. But there's a lot of issues, both with the type of data that can be gathered today, which is, if you really knew what Google knows about you, and people are all so passive about it, but it's amazing. And then the second thing is the nature of AI, particularly, and I'm sure Marla's struggling with this, is it learns. And so if you have an outcome you don't want, that doesn't mean that this economically rational AI won't come to that outcome, and you won't necessarily. Once you've set up an AI, you don't really have the ability to find out why it's making its decisions. You set up the initial thing. It's very hard to go back and find out why it's making its decision. So that is going to be a continuing and larger problem, and it requires us to get way more focused on what's our end outcome that we want, right? Rather than in the weeds about which data points or other things are used, because we could easily get into a situation where because it's the quote-unquote economically rational thing, we'll be doing stuff with socially damaging implications coming out of the use of this data. And there's a larger data question about who has it, who's using it, who's selling it, and what the implications are ultimately for all the rest of us. But that's probably another seminar.
Definitely a full-day seminar. I'd like to thank everyone for your attention and for participating in this. I'd like to thank our panel. Please join me in giving them a round of applause for your very thoughtful comments. I really appreciate the ability to set the stage and the way that you guys were able to do that. So, so thank you, and appreciate that. Into our next, to our keynote presentation.
Sorry. Okay. I think we're going to stay Thank you.
No, go ahead. I'm going to stay up there for a second. You guys are going to move the podium. So please hold on to your seats. I'm excited because of everything we just talked about and setting the stage and talking about financial technology. And I have the pleasure of introducing our keynote speaker, Mr. Hans Morris. He is, I just feel very fortunate that we have you with us. Come on up.
Great job.
And he is currently the managing partner of NICA Partners, a fintech venture capitalist firm in New York and San Francisco.
Hey, how are
he is
you?
also the chairman of the board of Lending Club and a board member of a portfolio of companies. I don't know if that's me. I wasn't laughing, so it must have been somebody else. I am so pleased to have you here to really take us into this next conversation about where technology is and some of the issues that we talked about in terms of barriers, where you see things going there. So I'm going to turn it over to you, Hans, and thank you very much for being with us, and we really appreciate it. Thank you. Welcome.
Part of the reason I was so interested in speaking here is my undergraduate major was in government and urban studies, actually urban economics, really, and I was an avid reader of the Urban Institute publications back then, so I'm a big fan. And so, do I have a some sort of?
Sorry, it's right behind you on that.
Okay. So I'm going to talk about. There we go. I just click here. There we go. That's me. Okay. I'm going to talk briefly about what NICA is, and then I'm going to talk about developments in mortgage technology, some of the issues we talked about today. What are some of the real policy issues? And then I'll talk about some discussion topics. I'd like to get your feedback. I also thought it'd be interesting to mention my background, which is a little bit more before I got into this. I was at, as I said, I was an urban economics major, and I worked in public finance with state housing agencies in the early 80s. And then in the late 80s, I was head of mortgage finance, and one of my assignments was we advised the RTC on sale of almost all their mortgage companies. So I worked on something like 50 different mortgage company sales then. Worked on the IPO of Margaretten, worked on the IPO of Capital One and PayPal, lots of other credit-related businesses. I then became CFO for Citigroup's institutional business and was also responsible for technology and operations. So a lot of the spaghetti problems that we're talking about was basically on my watch. So I would say I have a lot of experience with disasters of all types in that 30-something years. Let me talk about NICA briefly. We invest in lots of financial technology companies. We divide it into 4 different categories. So one is payment solutions. Second is alternative credit. So I am chairman of the board of Lending Club. We've got some other companies like Affirm, which is one of those point-of-sale lenders that we were just discussing. I'm not going to talk so much about that today. I am going to talk about digital advice just for a second. I think this is an extremely important development. And the reason is, if you think about just the United States financial services industry, there's tens of billions of dollars spent on agents and brokers and intermediaries, some of whom do a really good job, but there's lots of biases, there's lots of expense, there's lots of conflicts of interest in that. And today, I would argue in many cases, the machines do a better job. They're programmed to be compliant. They actually give you better tech interfaces, easier to answer questions. And so, and they're much cheaper. So if you take SigFig just as one example, which is a robo-advisor that's being used by Citizens and Wells Fargo and UBS, the cost of allocating your capital, let's say $100,000 to invest, which would be 95% of all American families have less than $100,000. So the cost is 25 basis points versus a couple hundred basis points at Merrill Lynch. So my view is this is going to be a very important and welcome trend, actually. And there are issues which I'm going to talk about, but this is important. So we have several companies that are part of that, including some like Acorns, which is a savings tool. Digits is a similar savings tool. And then financial infrastructure is the core systems. And I'm going to talk more about this in a minute, but there's lots of good ideas. It's really hard to change these systems. And I'd be happy to discuss this in more detail, but I will talk about it a little more detail later, but I'll also be happy to talk about it in Q&A if you want to understand how it exactly works, and why it's hard for governments to change systems, why it's hard for banks and any other large company to change systems. Okay, so I wanted to talk about a presentation that I gave back in 2012 at Fannie Mae, which is to talk about the first ever CIO conference, and this is what I talked about. I said that there are, in the mortgage system, as I said, I go back a long way. I just want to take a step back here and explain how is the fundamental design of the mortgage system works, and it goes back to the 60s. Actually, when paper processes were originally automated. So if you think about it, you have the idea of MBS, mortgage-backed security, is that you take enough diversification of mortgage types across multiple zip codes, and you have a certain down payment assumption, you have a certain debt-to-income assumption, and then with private mortgage insurance, you could model that, and you will say losses will be, let's say, less than 0.5 of 1% over the life of the portfolio. That basic idea meant that reps and warranties was the method that you said, that's how we assure all the mortgages coming into that system meet those requirements. There was no system to all that work servicing, at servicing representations, right? Your servicing rights carried with them those representations. But then the servicing rights were transferable. So the person that bought it then assumed those obligations. The point I'm making here is the systems, not one single system captured real-time the risk. And the risk is complicated because you have the mortgager, their characteristics are changing, they're getting divorced, they're losing their job, they got a healthcare problem. The house is changing in value. It's going up, it's going down, there's a flood, there's changes in economic activity, and the house you lent to in North Adams, Massachusetts in 1975 would be worth a lot less in 1985 when Sprague Electric closed. And so all that's changing, and then the claims on that house are changing. Taxes are changing, first mortgage is changing, second mortgage got fixed and floating. So it's a complicated equation, but not one single system measured that. So keep that in mind. All of the legacy systems are based upon that fundamental design. So, sorry, I can't see this. I have to look it back periodically. So the impact of the mortgage crisis, think about that. Now, suddenly, the whole system went amok. You had $3 trillion of bad mortgages originated, and these reps and warranties, it turned out like this was a mess beyond belief. And the $3 trillion of bad mortgages was partially due, about 2/3 of it was really fraud, or fraud-related, and 1/3 was bad underwriting decisions. But $3 trillion is a change like, maybe in the entire history of the United States, there's been nothing that dramatic that's that big a bad error. Other financial services industries don't operate this way. They capture real-time risk. Credit card businesses capture risk. You're constantly looking at what I should do to either extend credit lines, decrease credit lines, manage risk profile of your users. And Silicon Valley startups were also very focused on just this consumer experience, which we talked about before, which not all the things that we discussed as the result of the crisis was to increase all the documentation requirements. And that then made the whole consumer experience worse, not better. So we talked about how this could work, and I'm going to talk about this in more detail, what role Fannie Mae could play. But in 2012, there were not any Silicon Valley companies, zero, focusing on the mortgage industry. So the world was ripe for disruption, and there are now dozens, maybe hundreds of companies. I just want to give you an example of some of the characteristics. Some of these we've invested in, which I'm going to highlight in a second. But But generally, what we feel is many of them are focusing on this customer experience. Some are focusing on things like, the companies here like DocuTech and FormFree. There's many other businesses that aren't on this. That, for example, TrueAccord uses machine learnings to manage collections. Acorns helps on savings. EarnUp, Dave talked about before. So there's lots and lots of other companies that are not directly related to mortgage, but affect some of the issues that we're talking about in mortgage technology. So let me just give you a couple of examples of companies we have invested in that we like. So Blend is digital mortgage origination. They're actually presenting this afternoon, so you'll hear all about them. There's probably 4 or 5 companies doing that. They are enterprise-based, so they're not going out trying to get their own customers. They're working with big lenders like US Bank and Wells Fargo. AI application underwriting, this is, can you use data to create a defect-free mortgage? That's what they are doing. So it's eliminating all the things which might cause the mortgage to be repurchased. And if you can do that at very, very low cost, that drives significant competitive advantage. Rethinking servicing. This is a big area for discussion. Why is this not? Servicing systems right now are pretty stupid systems. They send out a statement to you. You either have the money or you don't. The machine doesn't know if you have the money. It's just sending you that statement. It's not an interactive tool to help you as the borrower figure out when you should pay it, how does this rank in your other obligations. It also doesn't, the servicing system doesn't give real-time data to the investor, which would be very useful. They have their own giant enterprise systems they built to try and figure out the output of the servicing systems. But it's not a real-time, insightful look. And the last thing is to modify anything is really complicated. These are really old, messy, hard-code systems. So if you want to modify the mortgage, it's challenging to do it on those systems. So Scratch is an example of a company which is built from scratch. It's a servicing system designed to give better tools to the lender, to the borrower, and to the investor to answer those questions. Equity marketplace platforms, Roofstock makes it easy for people to buy a single-family home and rent it. So you can sit in Hong Kong and tour a house in Bloomington, Indiana, and decide to buy it and handle all of the issues through the system. Achieve is basically helps if you're a first-time home buyer or any-time home buyer, it allows you to make a 100% cash offer, and they take the risk that you're going to get the mortgage. And so they can make that decision in 24 hours, and they will estimate whether or not you're going to get a mortgage in the next 6 weeks. Built is a tool that if you're doing construction lending for housing, it can, it's a tool for the lender, the developer, and the inspector to align on the same tool to assert that the affirm that the necessary improvements have been made so that the line can be increased. Everyone's using the same tool, eliminates a lot of risk and paper in that. And then Spruce is a new title insurer. So let's give you a couple of examples. We've invested in all these companies except for Spruce. We didn't, but it's a good company. I liked it a lot, but we ended up not doing that one. Let me talk about some of the key issues that you were talking at the last couple of panels, which are what are the public benefits and concerns around this technology. And the first is, I would say, it's very clear that there are very important benefits that come from this. And I think that these affect all constituencies. I think you get lower fees and better alignment of interests for the consumer. Importantly, you can lower information costs. There's many things which are high information costs. A lot of the things we were talking about earlier today in the last panel. If you could abstract away all that complexity and make it easy for someone to understand something, just as intuitive as many of the best applications are, that's better. Similarly, you can dramatically change the customer experience. Who likes signing all those forms? Doesn't matter what income level you are. It's terrible, and it's redundant. They're stupid forms. You say, I just signed this. They say, well, this is a different one. This is your RESPA thing, and you say, it looks 99% the same as the one I just signed. They said, oh, we need this. So, if you could eliminate that, it would greatly reduce cost and the experience, and then real-time settlement and real-time data can reduce systemic risk. just as I was saying, when the housing crisis hit, when Dave was talking before about what a mess it was sitting there with this dramatic change, you didn't have the tools to respond. Policymakers didn't have the tools, regulators didn't have the tools, lenders didn't have the tools, and the homeowners didn't have the tools. And then another thing which we talked about before is there's lots of behavioral bias in the system. That's racial bias, that's also just human nature bias, that's people, it's bad behavior in some cases, but it's also sometimes well-intended behavior. It's just that we do things the wrong way, and you can correct that through technology. And then I think this is the last important point is why should anyone cross-subsidize anybody else? You should be paying the right rate for you, and that rate should reflect a real assessment of your risk. And if you can use technology to lower that because you are going to pay them back, that's a really important benefit. So, and I'm going to talk about that more later in a second because I think that's a key issue. But there's really important concerns. I think we mentioned many of them. My list would be there's fraud, outright fraud, and then there's other ways that data can be used for illicit purposes. Cyber attacks and malicious activity are just one part of it. If you trust something, how do you know that that data is being protected in an effective way? And Equifax is certainly an excellent reminder of that, but that could happen in even more dramatic scale. And will this help, or will it make financial inclusion worse? And I would argue it should help, but there's a risk that it won't. And then will selection bias, if you don't have all these tools and you're a small lender, does that mean you get left with the worst risk or higher costs? Are we gonna make it so that if you can't invest in all this, you're out of it? And I call this the denominator effect, which is if your good customers start leaving, even if you just have 10% of your good customers leave, the impact on your profitability equation is quite significant. And then this issue about existing players being disrupted, that includes regulators, includes everybody is worried about, well, suppose we're not in the middle of all this change taking place. I'm actually going to say I think that's remote. I think building a full stack originator, doing everything yourself, is very hard to do. You can't disrupt the whole financial system. You have to plug into the financial system for various parts. So almost all the companies that we've invested in are complementing. They're part of this ecosystem. So you got to change the whole ecosystem in a productive way, which is what I hope we will talk about in a minute. So I want to talk about one of the questions people talked about earlier, which is what are the mistakes that happen in credit models? And don't forget, it's credit, so it's risky. And you could go out, I could stand out on 19th Street there and make $100 million in mortgages without any problem whatsoever. I mean, no one maybe no one will pay me back, but I could generate a lot of mortgage volume. So what are some of the mistakes? Well, first of all, fraud is a big problem. And fraud changes. Fraud is, it mutates, and fraud gets more and more and more sophisticated. And so you need very sophisticated tools, and they're not stable. The fraud this year will be different than the fraud next year. This customer selection bias, if you go out and you just use keywords on Google and you say mortgage, that's a very dangerous thing. What you want to have as a lender is an advantageous access, a positive selection bias. The good customers are coming to you, not the bad customers. Many models we see, technology models, don't address that. There's no competitive advantage of access to the customer. And then I've been doing this a long time with mortgages in particular. The models are wrong. I remember when I started in 1980, we were using all these FHA decrement tables, and then FHA came out in 1981, I think it was, and said, by the way, the models for the last 3 years are wrong. Here are the new ones. But that's true. I'd say all the mortgage models every couple of years say, you know what, that's wrong. And so there's real limits of AI. I would say that AI is not good in credit. And if you want to pause for a second and just, if you only remember a couple things from this talk, I'm going to tell you what are some of the criteria. Where does AI work well? AI works well when you have a clear and simple rule set with complex data. It also works well when you have a short-term answer, yes or no. Was it right or wrong? So if you think about a mortgage, the rule set is not simple, it's complex. The data is complex, but that's not the problem. But the timeline to determine if you're right or wrong is very long. So you can use AI to predict whether someone's going to get a mortgage, because you find that out quickly. You can't use AI to determine, it's very hard to use AI to do a longitudinal study over 30 years or something and see if you're going to get repaid, if your model really worked well. So the other thing is supply and demand changes, like credit stack. Like you make a loan today, you think someone's a good credit, and then they go get a lot of other loans. And you don't really, it's hard to put that into your model. And then these behavioral changes happen. So we talked about this issue of psychological commitment is a really important issue in debt. Do I have a commitment to pay it back? And another way that we found that things change is that the way the world looks at that will be different. They will look retrospectively. Something was not a problem before, suddenly becomes a problem because it doesn't seem fair in retrospect. And then behavior changes, like taxi medallions used to be a very good business until Uber came along. And even in the financial crisis, all the models would say, you pay your mortgage first, and you pay your loan second. And in the financial crisis, the expression which you probably heard, which is, you can sleep in your car, but you can't drive your house to work, that people pay their auto loan, didn't pay their mortgage loan. And then the data's complicated. This issue, don't be creepy, and disparate outcomes. Everyone, who here knows doesn't know what disparate outcomes is? Does anyone know this? Okay, well, you have precluded classes that you can't use racial or race, sex, age discrimination. But if it turns out your model did discriminate against those things, then the CFPB or the Fed or an OCC can come in and say your outcomes had a racial bias to them, for example. So that is a big issue in these fintech companies. They're very worried about this. And however, I would say this whole thing needs renovation. And a couple of areas where we should all focus on, because if you said, for example, CFPB granted a no action letter to a company which is using what did you study in school and what were your grades? I think that's a perfectly reasonable thing to say. If that has good credit outcomes, if someone's really poor and a Latino immigrant and they're a great student, why shouldn't they get a mortgage and use because they're a nursing student and have top grades? If that helps them get credit, that's good. However, some people won't win in that system. Similarly, right now, it's perfectly legal to discriminate on occupation. It's not precluded. But you could use other parts of data, like do you attend your job regularly? That I think would be a pretty good predictor of credit, but that's a touchy question to start investigating. So, and then the other thing, mortgage lending requires lots of capital. You have liquidity risk, credit risk, and operational risk. And these are very long cycles, as I said, and the feedback and tools are, you need a lot of capital to make sure you get through all that. So this is my discussion slide. So I'm going to put up a couple of areas to focus. First of all, I think everyone should agree is the point that both Dave and Andrew said is, I think everyone is committed to 100% digital delivery. It just takes cost and risk out of the system. So I think that's well on its way. I think, okay, here's an important question. You could create a system where you said, look, of all the people that apply for a loan, probably 50% of them we could approve and fund it in 48 hours. In my view, that's a good outcome. That means some people won't because they're harder to underwrite. I don't think you have to have the same rules for everybody. I think that, there's many benefits of having faster delivery for the people where the risk is very low, and you can have a lot of data available about them. Smart servicing tools I talked about before. I think behavioral insight from financial education is a very important issue. It's what Todd was talking about before, which is there's lots of tools I can give you which help you figure this stuff out. And I'm going to learn something about you, which then I can apply my underwriting model. And I could see how you're going to behave in certain situations. I think if we have time, I don't think we're going to have that much time, but I'd like to talk about new approaches to authentication. Authentication is changing rapidly. I would argue it should be fundamentally different than the way it is today, the social security number and passwords and all that you've heard about. But there's some very good ideas, but this could actually lower a lot of the costs and friction associated with lending. And then this issue I said before about continuous real-time data insight. That helps everybody. This is something that should be, we like tools that do this. I think all of you should like tools that do that. And then hedging real estate exposure. If you're a first-time home buyer and you said, look, would you be willing to sell 50% of the appreciation in the house if we give you, in effect, help you finance your down payment? So Stanford University does that, or you don't own all the appreciation if you're a professor. And there's a lot of other educational institutions, even high school level, that are trying to finance teachers by saying, look, we'll share the appreciation in the property. There's many models around this idea, and then last is good processes for technology engagement. And what I feel here is a policymaker group like this, to me, it would be very, very helpful if even if the laws aren't going to change, if we can help develop consensus around a couple of these important developments where we feel technology does solve this problem, we're concerned about this risk. The engineers and and I'd say the entrepreneurs will help figure that out for you. You don't need to figure it all out, but it is extremely helpful to have alignment around some of the objectives that we have as an organization and sharing those with the technology community, which can then go build those into their systems. So that is, I think we have a few minutes for discussion before you get to have lunch and talk to your friends, but are there comments? This slide's supposed to get everyone really agitated or react. So if you're not reacting, looks like your blood sugar level's too low. Yes, sir.
On your bullet there on digital IDs, authentication allows network formation. Network formation allows markets. Authentication allows network formation allows markets. Move those markets forward, you change industry structures. Tell us more, elaborate on your thoughts on how that's going to happen in mortgage. And just as what's ironic to me about the whole conversation is that the mortgage industry led the efforts on digital identity in the early 2004s and then dropped it. So where are we?
So I think, first of all, I want to say that this is a big, complicated topic. And there's lots of ways that digital authentication plays into the financial system. I'm going to rattle off a few, and then we'll come back to mortgages. So it's used for fraud, on credit card fraud. Figure out, is it really you or not? It's a very important use case. It's used on employee fraud. It's used on whether you're an Uber driver, whether you're a risky Uber driver. It's also whether you're a risky Airbnb customer. It's used in medical identification. It's used in KYC onboarding for banks. So there's many uses, and there's different companies that do different parts of it. The fundamental things would say, okay, should we use something really different, like a combination of biometrics? And there's lots of interesting technologies around that. A more profound shift is also saying, should we give you the control over your identity? Do you create a vault and give it back to you? So you open that vault and you say, okay, permission now to see information. You would only grant it to trusted people. But I think that's a pretty powerful idea. And if I was advising, for example, some of the consumer advocacy groups, I think this is great, because now the key question there is, who do you open to, and how can you authenticate the trusted lender? And I think that's a good role for regulators or other groups to do. But if I control it and I'm saying, look, if you're going to give me credit, I'm willing to open up and let you see my tax return, my really authenticated insight into my employment record. I'm willing to let you see my bank account and see the cash flow in my bank account. There's a lot of data there that could lower costs dramatically, particularly if I'm a hard to underwrite person. You'd have to trust it. And again, I would look at that and say that's a very important opportunity. There's plenty of risks, I acknowledge that, but I think it would lower cost to the person who is seeking credit.
There we go. I want to take you up on your offhand statement about risk-based pricing. And this is a hot button issue because of the issues that Marla and Nikitra spoke about, and also the issue you spoke about not having the systems to deal with forward risk as opposed to backward-looking risk. Talk a little bit about how we can have the insurance systems that the government stands behind in the housing industry with pure risk-based pricing, given our lack of knowledge, our lack of forward-looking systems, and our backwards history of discrimination.
Well, I would say discrimination, I would think technology can address discrimination pretty effectively, because as I said, machines, I realize that you could say if you have, let me start from the beginning. You take a credit score, say how is a credit score calculated? Credit scores, particularly for credit-worthy customers. So if you're a 700 FICO score, so about half the households in the United States, that's a pretty effective ranking system. If I say a 720, 720 is better than a 700, a 740 is better than a 720, because they're pretty much backward looking. If you think that the future's the same as the past, it does a really good job. And if you have a good credit score, it's probably because you have a job, it's probably because you have health insurance, and it's probably, often you're married, so you have stability in the major drivers of your financial outcomes. What happened in the financial crisis, like half the households are not creditworthy, right? Don't meet that. Some are marginal. Some are people that were 60 days or 90 days delinquent on their mortgage because their mortgage is 20% underwater. That person might have a really good job, and they may have good intent. So Credit Karma is a good example of a company where you get credit score. That's basically, it's just taking people who are 7 or 630 and saying, I'm willing to take actions to improve my credit score, and I'm interested in this. That's a signal of good intent. And so that's used now to help identify better borrowers. The other things that you might, you could do, which are alternative data, as I said, you might say, well, if we knew this person, they might be an immigrant, so we don't have any credit history, but they have a master's degree in nursing, and they should be able to make this amount of money. We can underwrite that person even though they don't have that score. So I'd say future models, I'd say, I would be quite bullish about it. Now, if you say, well, what about the issues of discrimination against, some of the protected classes? I'd say, as I said before, all the fintech companies are very aware, more aware, frankly, than the people in this room, because no one said they had heard of disparate impact. Disparate impact is a big deal to the fintech industry right now, to make sure that you don't. Sorry? Okay. Well, I said, who's heard of disparate impact? No one raised their hand. So, okay. Who's heard of disparate impact now? Is everybody? All right. All right. Okay. So now we're all, we can relax. So, but what I'm saying is, that's what I'm saying. If it turns out that your model was discriminating against race, you have a problem. So I think tech companies are very aware of this and trying to make sure that they don't discriminate that way.
I guess my real question is, if you think that that risk-based pricing is an absolute positive thing we absolutely must have if we're going to have an efficient financial system, I could ask you, how long will it be before our models are good enough to support it without running into disparate impact problems? And what do those models have to have in them and be able to do in order to be able to support it without running into serious, and I mean real disparate impact problems where people who should be getting credit aren't getting it?
Mm-hmm. Yeah, and I also wanted to, hopefully when I start out this whole talk and I establish my bona fides and my fair-handed, I thought, assessment of the risks and issues and what goes wrong in these models. So I would not describe myself as like, I ask a lot of those same questions and are very worried about how good the model, and I don't trust some engineer just telling me, I have a PhD in machine learning or something, because I feel it doesn't work, right? So I'm very aligned with you. However, I really do believe we should be, well, first of all, I don't think anyone who's a regulated institution is just going to use, you're going to have to prove what your model does. And so the model validation process of any regulated institution has to demonstrate. You can't use machine learning to say, we don't know how it came up with these answers, it's just this is our new credit model. No one's going to prove that. You have to say, you may use, and that's why I say machine learning and credit is not a good, it doesn't work well. I think it's going to be more like better robotics, getting to some of these decisions faster. But generally, my view is we should be encouraging, but also careful and being mindful of just the risks you're saying. But I would say we shouldn't stop working on it. We should work hard on it. Wrap up. Okay, now is time for lunch. Thank you all for joining us.